All right, so we've reached the bottom of the hour, and as promised, we are going to welcome in chart trader Brett Manning. And Brett, before we get too far into this discussion, I need to address something with you, if you will.
You got it. Go for it.
So I got a text from a friend of mine named Achilles, and he said he's recently been getting followed by some guy in a Florida Gators hat that's been snooping in on all his conversations with his pals. Asked me if I knew anything about it, so I thought I'd ask you.
Yeah, no, that's our primary source of information.
Yeah?
Yeah.
And of course, anybody who doesn't understand what we're talking about here, that is how he had a little intro to his chart book. So, Brett, I will have that on the visual for everyone to reference. But okay. Why don't you go ahead and give us a breakdown of some of your thoughts on that, in introducing that concept.
Yeah, sure. So we've been talking over the last few times when we've had our conversations about my shift in bias toward a bearish near-term bias on the market for a break of the February lows, and that's very much a recognition of what I believe is a change in mode, which mode is a very important term to me. It's just kind of a behavioral dimension of the market. When certain things start to shift in terms of the way that the market responds to different things, and a good example is how we have seen an inability to rally on all sorts of things, great earnings, apparently denuclearization of the North Korean region, and several other things. Whatever the market gets thrown at it, it can't really hold a sustainable rally. And that shift in mode is the first and most important thing to recognize. And I can come up with an argument that I believe is plausible for why that's happening, why there is suddenly a lot of supply of stocks on the market to be sold. And in my chart book, I went over three big reasons, really the first two bigger, and really the first one biggest, which is basically a shift in the paradigm of what I would say are what I call the fixed income refugees. They were forced out of the bond market because there was no return or even a negative return in lots of places around the world, and that money got pushed into stocks. And with the recent move higher in interest rates, particularly since November, we have started to once again see people who live in an industry that for 50 or 75 years has always acted the same way, except for the last few years. And now I think they're very happy to go back to acting the way they have in the past, where they can get a risk-free return guaranteed by the federal government on an interest rate, rather than looking for a dividend payout in an equities portfolio that has the potential, especially when we see volatility levels rising. When you had a VIX under 10, it's a little easier to say, hey, maybe we don't need to be in such a rush to get out of this position. But if you start to look at, a VIX between 15 and 22, which is historically where the VIX is, if you go back as far back as the VIX goes, a long-term average is about 19. It's very different than what we saw last year, from the summer until the end of the year, where the average was about 9. Now, if people are thinking we're headed back to stably around that long-term average, and you see the one-year T-bill trading above the S&P dividend yield now as of just a couple months ago, that means that basically the whole Treasury curve is now a better return than the average dividend from a large-cap stock. That's a paradigm change, and I think that's where the supply is coming from. But regardless of whether I'm right on that or not, the conversation between Achilles and the tortoise, and by the way, for anybody who's ever read the book Gödel, Escher, Bach by Douglas Hofstadter, that's where those characters came from. He introduces a lot of his chapters in that by conversations between an anthill, a crab, a tortoise, and Achilles. And so I borrowed those two characters. But the point is, and I think the most important point, is probably in the second tortoise quote, which is you don't get signals of poor second derivative growth before the highs. And a lot of people are looking for monitoring the stock market by looking at economic and earnings performance as an indicator. And when you start to see things deteriorate there, it may be time to look for bearish movement in stocks. And I've been through 3 market cycles, and that's never happened. That's not how it works. The highs are put in when everything looks the best that it could ever look. And the move just short of the highs, after the highs have been put in, usually looks the same way. When we look back on history, we attach these obvious negative narratives. You think of the break of the dot-com bubble, and you think of, the second half of the year for 2000 as, so obvious in retrospect that a bear market was happening. But if you were there, if you were trading that, not at all the case. Things looked amazing. Earnings growth was incredible. And the new economy and the idea that the type of numbers that you need to look for, the traditional metrics don't matter anymore. Here's the metrics that define the new economy, and they look amazing. And that's how it looked, even after the highs. And when the market started going down, everybody everywhere on TV, in the press, was just looking at what a great buying opportunity this pullback was, until suddenly the NASDAQ had dropped 88% by a couple years later. I'm not saying this is a new bear market. It's not impossible, though. It's not inconsistent with the way that cycles turn. It would just mean that in retrospect we start to see that there was a deterioration going on under the surface that wasn't being reflected in estimates yet. I don't know whether or not that's happening. That's not really the point. My point is you can identify the mode of behavior shift, which is simply that, things look amazing. I mean, things couldn't look better for the economy, for the earnings growth curve, and the market's just not responding the way that it had in the past. That's an identifiable and objective statement. And when you see that, that's how it does look when you're starting a bearish move. That's the real-time way that you see kind of bigger tops come in. I don't know this is a bigger top. I don't care whether or not it's a bigger top, because if I start getting hung up on trying to say where the market's going to be 2 years from now, then, it's just distracting. The most important thing is to try to understand, and look for signs of confirmation that the mode has changed, because this could look all different in a week. It could look all different tomorrow. But I'm starting to see more confirmation of the sense that it doesn't seem to matter what you throw at this. It just kind of, tries to rally a bit, fizzles a bit. We've got some bear trigger levels below. I marked out 2 in a chart this morning. Obviously the 200-day moving average. These are all levels where if you bunch up along it, you try to hold it, you try to hold it, you try to hold it, and then you slip below it, you can see an acceleration. So we have kind of a number of those possible triggers that the market is starting to close in on. I've got a short position on now. Not a real big one, but, it's not nothing. And obviously, if I am correct about the shift in mode, then there will probably be interesting opportunities, whether it is necessarily adding to this particular trade or putting on a different trade. But the shift in mode is a shift to from a wall of worry to a slope of hope. And what that means basically is, in a wall of worry, you get some piece of news that shakes the confidence of the market, it stabs lower, and then just starts to grind higher without any sort of real catalyst. In a slope of hope, it's pretty much the opposite. You get some kind of headline, some sort of development, rips the market higher, and then it just starts to kind of fall back down of its own accord. If that's the kind of situation we're starting to see right now, and that's a big if, but it seems to be the case to me, if that's the case, then those sorts of moments are the moments to short. So it'll be a process of kind of trying to look for confirmation of that modal change, and then a process of looking for specific instances of that kind of phenomenon.
Okay, so part of that thesis is your analysis of some of the sentiment indicators, which you also provided in your chart book. And they're not super bearish per se, are they?
No, well, so that's kind of the point. So what do you mean? Do you mean they're not showing super bearish sentiment, or they're not showing me a super bearish picture?
Both.
Okay, so yeah, and they're neither, right? I mean, it's not like people are all bulled up right now, but they're more bulled up than we would see if this correction was over, in my opinion. We've never, for most of the indicators that I follow, and I put a few up in the chart book, I follow more, but these are the ones that I thought kind of told the story right now. And, there's really nothing out there that directly contradicts this, except for maybe the commitment of traders on the VIX futures market, which I did note in the discussion, kind of says something a little different, but there's nothing else that really says much different, and this is sort of like a combinatorial game, just kind of looking at a number of different things and abstracting the general theme that emerges. And in this case, from what I'm seeing, I've talked about the robo ratio a lot. For those who aren't familiar with it, it's one of my favorite indicators. It's the retail-only buy-to-open put-call ratio. It's taken from clearinghouse data, not individual reports or surveys. It does show, based on accounts, what position is established. So if you buy a put, it's not just that a put was bought, it's that a put was bought as the opening of exposure in a particular security, a particular underlying security. So we know, for instance, that it's a short bet rather than a hedge. And the retail-only side of it just means smaller accounts. So people with smaller accounts opening bets using derivatives. So what sort of bets are they making? And generally speaking, at key lows, they are pretty much, if you look over the course of this bull market, just about always moving in a herd, making leveraged bets on what they believe are overpriced stocks finally heading down. And if you look at some of the charts on things like, the FANG stocks and all sorts of stuff, you can see a lot of things where people, if they start to feel bearish, can say, man, I could just get rich by buying a ton of puts on this. I don't have much money now, but if I leverage it up in the options market and this stock drops into a big correction, whoopee. And when a lot of people start doing that at the same time, it's a good sign that you have a low. And we're not even seeing anything close to that right now. So the other one is the National Association of Active Investment Managers survey. Basically, what's your exposure profile? Are you net long, net short? Are you leverage long, leverage short, neutral? What is it? It's a survey, but it's reported for people who are members of the National Association of Active Investment Managers. In January, by far, nothing's ever even come close to where they were then. And so far in this correction, they have gotten back to the halfway point. And in prior corrections toward the lows, they're all the way down, well net short. And right now, they're sort of neutral to slightly long the market. And they've never had a moment since the highs in January where they've been net short. So next is the AAII bull ratio. We did have a dip in this. We did show some bearishness, but it was really for like one reporting day, and then the whole rest of the time we've been bunched up above neutral. And inverse ETF volume, which I think is interesting, I've started to track that more and more. When people suddenly get really interested in these things, it's usually kind of like that robo ratio situation where you have people looking to turn a small amount of money into a large amount of money because suddenly they're pretty sure that the bear market or the bull market is over. Right now, volume spiked on the February drop big time, but it's dropped back into the same area in terms of volume that we were at even before the correction even happened, and that's where we're sitting right now. So there's sentiment. I think that means that probably a slide is coming. If this is a correction that leads to a new leg higher in the bull market, then at this point, given the duration of the correction, we will probably need to see a lot of these things start to really ring the bells for us to be able to say that we've sort of capitulated the weak hands out of the market, and we found a market where it's not emotion and sentiment holding it up. It's a real underlying kind of current of the market heading on its next leg higher in the bull market because there's that capital sitting there waiting to be put to use.
Okay, so in terms of this particular trade, it's hard for me to ask because you're not so much of a levels guy, but if you were, if you're looking at an inside target, what would that be? And if not, what is the change in sentiment that you're looking for that would trigger you to cover this? Because I know it's not a big position for you, so are you looking for a big home run on this one? There's not a whole lot to just piece away, perhaps, right?
Yeah, so there's a couple of interesting ideas there. One, I'll answer the second one first. I never come in with the mindset of saying I'm looking for a big home run because that just makes the trade an emotional thing, and I feel like I lose my objectivity. That doesn't mean that I don't get large in a position. It just means that I'm always kind of able to assess the risk-reward from the standpoint of I don't lose my bearings on the idea of I know I'm right, I'm just throwing caution to the wind and pounding the bid here. But that said, I do look at levels. And I look at mode and I look at the two concepts together. So if the mode were to stay just like it is now, there's no major change, we kind of keep this feeling going, we keep a grinding kind of move lower that's interspersed with headline-driven pops and that kind of dying quail follow up to that, and we sort of roll back over. If that's the mode and it's a slow progression lower and we don't see an explosion higher in the VIX, then who knows where this could head, because I addressed some valuation ideas in the chart book just for the sake of kind of, a lot of people will say, well, the market can't go lower because earnings growth is so good. If you look historically, when you see earnings this good, there's a floor that has to be there no matter what anything else looks like to you. And the point I wanted to make in the way that I address valuation is to show that you don't even need a deterioration in the current environment, and you don't even need a downward revision to earnings growth forecast over the next couple of quarters to justify a move down to, say, 2450. And that puts you right in the smack in the middle of normal valuations during sort of standard bull market cycles over the last close to 50 years. That's kind of where you'd be at 2450. So there's one way to think about levels. Another is obviously when you break that February low and the slope support across the lows that we've seen so far in this correction, if we see that be the bear trigger that I think it's going to be, in other words, lead to follow through and maybe a close on the lows, that should shift sentiment relatively dramatically. And if I see over the next couple of days the VIX really start to explode higher and the market not make too much more progress down, then I'll start to think about covering that right there. If we start to see emotional price movement, a lot of hedging activity come bursting into the picture, and a more rapid kind of action, higher volatility, more emotion in the tape, then usually that's how things start to get when you've kind of, already got the lion's share of profits in a short trade. So that's, looking at two different forms of mode and kind of giving a sense about a level. And obviously the 2500 level is probably something that's going to be psychological, because there's a lot of people involved in this market who don't really look at the stock market very much. And if we break under that level, probably there's going to be enough in the media and in the press that people with 401ks, they start to think about it more, and how we react to that level and that extra attention from sort of the rest of society outside of Wall Street and trading desks, and how the market handles that will be another signal of what sort of potential there is for this. But otherwise, if I just had to throw a dart at a number, I'd be thinking of a kind of notion of a target that is an extension under 2500 on an emotional move, so maybe 2475-ish.
Okay. Does the Fed meeting that is will have the rate announcement or lack of rate announcement in the press conference coming tomorrow, does that scare you off at all, or do you view that as a potential catalyst that might get us there?
I think that it's a total non-factor at this point. I think that we know exactly the path of the Fed right now, and I don't think that. I mean, okay, so obviously, if we went down 10% today, it would become a factor, right? Because they would be looking to quiet fears and maybe even pull back on any hawkish rhetoric. So barring something like that, barring a market event that forces it to become an issue that's directly addressed by the Fed in real time, I don't think that it's an issue. The next hike's coming in June. One after that's coming in September. We've seen the odds increase for a December hike as well. This Fed, I don't think, is necessarily going to be quite as reactive to downside in the stock market as past Feds. I mean, that could change, but right now that's my take. It seems like they prepared the market for that kind of approach during this tenure. So I really don't think it's an issue. Friday may be more important with the jobs data, wage inflation numbers, and how the bond market reacts. And as we spoke last time, if there's one factor that could shift things for me and force me to kind of go back to the drawing board about a lot of concepts, I don't think about the idea that we're going to see some kind of break under the February lows. I don't think it would really change that thought in my mind right now. But as far as the type of environment we're in, if we started to see a real sense that the top had just been put in for the cycle in long-term interest rates. There's so much bearishness around bonds right now. There's so much of an assumption that interest rates are going higher, and there's such a huge short position in Treasury bond futures markets right now, including myself. If it's possible that if we start to see something kind of receding about the animal spirits in the economy, about the sense of coming inflation, about the sense of growth. I doubt this is going to happen right now, but if that sort of shift were to start taking place and we see interest rates really start to pull back sharply on an initial big move down, then that would probably change a lot, because it would throw into question this whole idea that we're seeing a sort of more or less cyclically permanent move back out of the stock market for all of these guys that I've been calling the bond market refugees. If that's not really a done deal, then that same mechanism that came in as support in early 2016 could start to go to work again on some level, and it kind of shifts the math a bit.
Okay, I was reading some feedback from yesterday, and it was asking why you didn't add to the position in the E-mini futures after it dropped below the 26.45. Now, you addressed it, and maybe you just want to give a quick little recap of why you didn't add to that position. But also, considering that it was a headline move, where is a move back higher in which you would at least consider adding to that position?
Right. So, if I just could map it out right now, I would say, hey, Apple earnings are great, market shoots higher, and just like the other evening, it would be this evening when you're sitting at your dinner table that I'm adding to the position. So that would be that kind of idea. I would think that, as I talked about the concept of a slope of hope sort of mode, the best times to add to positions like this are after there's some bullish development that impacts the tape directly, and then you start to see the momentum of that impact start to fizzle, and that's the time to add. Because otherwise, if you add on breakthrough levels, I wanted to add on a breakthrough level, if it had grinded down there and under 26.45 without any kind of associated political catalyst, I would have added, but it would have been an uncomfortable add, because the problem with staying with a short in a bearish mode of behavior like this, sometimes the easiest shorts are bull market shorts where you just get lucky because it goes fast, there's no bounce to rip your face off, you just see it shoot down the chart, you get out when the emotion subsides, it's quick, easy money. Staying with a short in these conditions is tough, and you have to be a little careful and a little cautious, because what happens is you'll start to see something where it's really high conviction, and you just know you're right, you triple your position, and then a headline hits. And suddenly, on something that you're tracking well with, from a core position standpoint, you're suddenly red in right away. And even though it doesn't mean that you're wrong, it just makes it tougher to remain objective in terms of how you're managing things. Mm-hmm. So I've just learned to never do what they call short in a hole on a headline. And in that case, it's questionable. The one reservation I had is it's questionable as to whether or not the Netanyahu briefing was really the catalyst yesterday, or it might have been catalyst in the sense of it set off a process, but the process was something the market was pregnant with in terms of potentiality in the first place. That anything could have come along and set off that same process, and it's more confirmation that the bearish bias is correct. I suspect that may be the case, but just as a rule, I don't want to be shorting after a significant move lower that appears to possibly be something that was driven by some kind of headline event, particularly something geopolitical.
Okay, got it. All right, let's turn to a couple of the other markets. Most notably, you highlighted crude and gold. Which one would you like to start with?
Gold, because I got pointed out to me this morning by a subscriber that I just missed a very obvious opportunity yesterday.
Oh, talk about that, yeah.
Yeah, I mean, I've been stating this kind of shift in bias to short gold, to a firm and stable sense that the dollar is going to be strong right now. There's something underneath the surface there that's kind of like a perfect storm in a bottle. It's not necessarily a giant move, but it's a dependable one for now. And that's a good way to shake out some of the excess speculative leverage that had piled into gold, particularly after Jeff Gundlach talked the other day and said it was, something hugely exciting is about to happen in gold. That kind of is one of those capping events, and At the same time, we saw a geopolitical catalyst yesterday, and gold spiked up on it. And it's just the same kind of slope of hope logic. Like that was, for the gold market, that was like, great earnings by Apple today or something. Like that was the moment to short gold. It gave me a good risk-reward basis. And, it was a gumball, and I didn't take it. And now it's a very different risk-reward picture. Where do you put the stop on it, et cetera. To be able to manage it from a power position standpoint, I think it's probably going lower, but gold has notorious squeezability in a trend like this. Mm-hmm. So if we see something else like that, some kind of geopolitical catalyst, some kind of $20 per ounce pop in gold, I will probably be shorting it.
All right, and safe to use that slope line target that you have on the chart book as that zone of where you'd at least look to buy it back?
Yeah, that's it.
Okay.
I think right around 1250-ish.
Okay, got it. Anything to note in crude oil that you're looking out for? Had a big run yesterday. Go ahead. Sorry.
Yeah, I mean, crude is the most difficult to handicap right now because I think that it's still in an upward trend, I think. It still acts like it's in an upward trend. It still has core themes that haven't been challenged. It still has a mode of behavior that seems like an upward trend. But it's now running into the wind of this sharply rising dollar. And there's plenty of speculative long interest there, but it's the sort of bigger-handed, more experienced kind of long interest that you usually see really ramping up during a crude oil uptrend that's not so easy to shake out. And I think we've still probably got a lot of hedging still in there by shale producers, which could come off as well. And we still are seeing this basic dynamic where there appears to be a constraint in place and supply is just not able to ramp up very much in keeping with movements higher in price. However, this is up against the move higher in the dollar, and it's also got two-way volatility around a very front burner kind of geopolitical catalyst in terms of what's going to happen with how the world deals with Iran. So you got headline catalysts everywhere. You've got a tailwind that probably is trustworthy, but people have positioned in line with it, and you've got a headwind that's probably trustworthy and probably capable of shaking some of that out. So it's just something that I feel like I have a firm handle on from an analytic standpoint, and my conclusion is just to probably stay away from it.
The one thing that I have the crude oil daily chart up, and that looks like one of those ascending triangle patterns that you highlight quite a bit. So that really could get things going, I think, if you're just looking at that one. So no chance you're playing that, huh?
So you are talking about the breakout above the range of the last 10 days or so?
Yeah.
Basically?
Yeah, pretty much.
Yeah. I mean, I think that's a breakout that's going to happen, and yeah, I want to play that. But right now, I think that that's kind of something that happens if you start to see sentiment shift really strongly on the dollar, it doesn't turn out to be a new bull market in the dollar, start to roll over again in the dollar. We've shaken some of the speculative interest out of crude oil, but nothing changes about the fundamental backdrop there, that there's a constraint on supply growth with rising prices, which probably means we force enough of a rise in prices to get past that constraint because the market will provide. If the oil production becomes profitable enough, given a certain scenario, then people will invest in making that scenario happen. And that means more available workers, more available equipment, more available heavy oil, wherever you have to get it from. The price going up to a certain level will cause all those things to happen, and the market will find that price before it tops. And if that constraint is a valid idea, then it's going higher. But, if you buy it right here, I don't know where you put a stop. And I like to have a risk protection in.
Yeah, and part of the reason why I pointed it out is to get people looking at it ahead of time as I've known your style well enough to know, this is one of the things that ChartTrader likes to look at. Why don't we get it in front of people ahead of time so that they're looking at it as well, so that they're not blindsided or, hey, why am I doing this trade? It just gets everyone prepared for what may happen. Now, with that said, would you be inclined, if we get a move like that after the EIA data tomorrow?
I don't think so. I think that there's possibly, you kind of, take a look at the Euro chart at the same time, and I think that we've got an acceleration of this drop to where a pullback in the Euro is a washout kind of looking move. That may not take too much longer, just a big bar, a lot of volume, a lot of spec interest in there before. That kind of process, maybe where you're going to see a dollar pullback to take advantage of in that same kind of thing, because this is just a four-set play. When you get a dollar rally like this, it can become something that becomes more important to the market as it becomes more persistent. People start to talk more about it, and it kind of becomes a kind of, like a psychological meme. And if the dollar just continues plodding higher, I think it's going to be really tough to see the action we're looking for in crude. I think it's better to just wait for a situation where you have, one thing I like to think about is like, how hard is it to push over a tree? It's easier when you've got hurricane force winds blowing at your back, you've got a really old tree, it's dead, and it's got a crack in the base. So go around and look for trees like that if you're trying to push something over. So trying to push this breakout while it's a young tree and the wind's blowing against you, it's better to just wait until things kind of line up.
All right, fair enough. Let's see, have we left anything off that you would like to highlight before we sign off for now?
Yeah. So, one final thing is just the process of, if I'm correct in some of my assumptions right now, then one thing to look out for that can make it more difficult is the narrative that you see attached to market moves that's going to be probably a focus for what I will call the mainstream financial media. Nothing that I'm talking about here is probably going to be a part of that narrative. And the causality assigned to moves down will make it tough. A good example is yesterday. The idea that I was able to see that the Netanyahu press briefing was the reason why the market rolled over. It's very likely that it helped, but wasn't the reason it happened. But in the financial media, that's the idea. And you're going to see some kind of excuse given for any move down that makes it seem like a one-off, no big deal thing, rather than you're watching something that is, at least on some level, a change in the way the cycle is behaving relative to equity market prices. I think that this is a change that may change back. I'm not saying we're headed back to 1500, but I think that it is a modal change that will last as long as it lasts. But it's important to keep in mind the underlying current. If you think about a body of water, there's a current underneath that water, and on the surface there's ripples and waves. And the current, I think, is identifiable here. And the ripples and waves are going to be what's covered in the press, in the mainstream financial media, especially things where everybody likes a narrative that's easy to understand and easy to explain. The viewers like it, the anchors like it, the producers like it. It's easy to sign off on that. Okay, that's how we're covering this, because it's easy, it's digestible. And that bias, that preoccupation with putting out coverage of markets in a simple, bite-sized way that fits into mainstream existence it's prejudiced toward a certain type of explanation rather than a deeper understanding of what's happening. And when you see a down move in the market, that becomes a more prominent feature and something that can work against you if you're trying to take advantage of it, because you get confused about what you're seeing. So just keep that in mind.
Well,
and that's it.
Yeah, I'll definitely keep it in mind, and I'll tell you one person who doesn't like it, and that's me. And that's why we bring you on to break it down for us. All right. One of the things that I hope I can encourage you and Gavin to do is, on the release of the FOMC tomorrow, what I found to be really valuable was the way you guys were breaking things down. I can't stress enough how, when I was a young trader and trying to come up with ideas or how to play, or what does this mean when the Fed announcement comes out, how does this relate to gold and bonds and whatever, trying to make sense of it all. You guys were breaking that down in a way that I have never seen on any mainstream media. They might have quick little snippets or whatnot, but you guys were breaking it down really, really well, and I hope that you guys will do that again.
That's awesome. It sounds like a good endorsement. I think we probably will. Now we have to.
Yeah, I know. I did. That's why I did it on purpose. Putting you on the
power
spot
here, Jim.
Hey, got to use the force to my advantage. All right, my friend. Well, if we don't touch base later today, why don't we do a little preview tomorrow? Sound good?
You got it.
All right. Thanks a lot, Brett.